So welcome once more, guys, to our training today. I'm sure you probably have been wondering that I usually talk a lot about risk management, money management, and it's kind of like the meat of forex trading, in my opinion. Most people would want to think it's a particular trading strategy, or maybe a particular using bigger account or bigger funds and all of those. Those are important, really important. But money management, risk management, and trade sizing is kind of like the is what separates people who trade and succeed, and those who trade and fail. And those who trade and fail, are a lot. So let's kickstart our training today. So welcome once again. So we're looking at how to become a profitable trader and grow your forex account, and specifically based on trade sizing. I'll talk a little bit on margin, on leverage, and I'll then discuss discuss a bit on those and see how it pairs together as to make you a successful trader, right? So stay with me, and at the end of the whole section, I'll probably give up some. So if you have traders here, if you're already currently trading, you'll have some bonus tips on some pairs that I think I talked about one of them, the one I want to show you in my video, in my trainings, I think a week or two ago, and the market has moved a lot, and it still has a lot of potential to move. So we'll look at that at the tail end of the video. So disclaimer, it's important that anything I say here is for educational purposes. Only you need to understand that when it comes to forex trading, there are risks associated with forex trading, and you don't want to trade with money you cannot afford to lose. Well, that being said, I want to proceed. My name is Domi. I'm Alexander. I'm going to be your host. So my specialty is forex, cryptos, ETFs, and all of those financial markets in general. So what we'll be looking at today, so we'll look at trade sizing, we'll see why it matters, we'll see win rate versus win ratio. So there's a 4 quadrant section that I like to use, and we'll see how how that plays out, right? How that affects our trades, what implication, what are the three, there are about 3 ways or 4 ways we can trade, and you can be profitable in 3 systems. So we'll look at the 4, we'll look at where we don't want to be, and then we'll look at where we should be trying to be, in terms of priority, and then I'll wrap it up with a bonus on trade, 1 or 2 trade ideas that you can probably start implementing, and if you have a live account, so then you can choose to do trades, to take the trades, or plan around your own system. Okay, so let's kickstart. I like this picture very well because this quotes very well from Abraham Lincoln, because it kind of tells you that in order to succeed, success in anything actually is a lot more on the hard work behind the scenes. So the champions are not made in the ring, right? Take Anthony Joshua for example. Champions are not born in the ring. They are only discovered there. So the hard work, the main what I call it, the main thing that makes you champion is done off camera, off site. And then it's in the ring there that you're recognized as champion. So in the same way, when it comes to trading, it's the time spent in sharpening your axe, and that kind of like determines successes from failures. I'm sure we all want to be successful traders. So trade sizing. Let me leave this slide because I need to draw on my screen. So I'll share my entire screen. So trade sizing is what we'll look at now, right? We'll look at trade sizing, and then we're going to see how I'm going to try and explain the concept of trade sizing. I keep talking about this a lot, and I don't think I can overemphasize it. When it comes to forex trading, what you do have is your capital. So for example, if you start trading with a $100 account, or a $500 account, or a $1,000 account, what you have is your capital, right? That is what is yours. Now, your potential, what you're looking to make is, upside potential. What you're looking to make is profit all the way up. And we all want to make profit. Now, if for example, we'll say you have this whole pie is your trading capital, right? So this is what you have. Now, every other thing outside your capital is there are two. There are just two things outside your capital, right? And that's risk and potential reward, right? So this is what you do have, right? This is yours. This every other thing is potential. So potential risk, potential loss, potential gain. So potential risk, potential gain. Now, what we try to do is make sure that we limit our risk and then kind of like enhance our reward. So you want to make sure that we want to try our best to risk little, in order to make more, right? So we're trying to maybe risk one in order to try and make two, or necessary, or just not. Imagine taking a trade and then you're putting your entire capital at risk. Now you'd probably wonder who would be so stupid to do something like that. Well, a lot of people, I wouldn't call it stupid, probably ignorant, but because you're ignorant about something doesn't mean you won't get punished for doing it. Now, when it comes to the forex market, I like to say, don't risk more than 3% of your capital on any one trade, right? You don't want to risk more than 3% of your capital. Some people would say even less. Personally, I like to use anything between 1 to like 2.5% of my capital on any trade I take in the market. Now, this way, you can stay in the game long enough. As forex traders, we know that we don't win all our trades, right? I'm still yet to meet a trader who has never lost. It's not what we try to do. We're not in the business of never losing. We're just in the business of coming out at the other end of the market profitable. At the end of the year, at the end of the quarter, at the end of the month, we want to be profitable traders, right? In the long term. Now, so when you know you don't win all your trades, and that means there are potential for losses. So you're definitely going to lose some trades. Now, even if you have let's say you win you take 10 trades, right? So you take 10 trades, and out of those 10 trades, you will have like an 80% win ratio where you win 8 trades. Now that's a good number. If you don't size your position well, if you, like I said, risk too much of your capital per trade, you soon blow out, you blow off your head in terms of you run out of steam. Because just because you have an 80% win ratio, which is really high and mostly not is not really popular to have an 80% winning strategy. So if you have just an 80% win rate, that means you lose just about 2 out of every 10 trades. There is no guarantee that your trades will look like win, right? Just because let's say I'm going to use a 10 trade sample, so we're taking 10 trades, and out of those 10 trades, we're looking to based on the 80% win ratio. So we're saying win. So we have a win, 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 win. So there's 4, 5, 6, 7 hits, right? So don't mind my writing. I'm writing with my palm. So okay. So now an 80% win rate in your head might appear something like this, where you win, 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 lose, lose, right? And in this case, anybody can be successful. But what could happen is you could have a lose-lose before you have the wins, even in an 80% win ratio. Now, if you risk 50% of your capital, right, per trade, let's say you have an $100 account and you, let's say, use a lot size that costs you, let's say you have a $100 account, and then you use a lot size of, let's say, 0.1, which is a mini lot, where 1 pip is equals to $1. And then the trade you take is, let me say, 50 pips away. So you have, your trade is 50 pips away, right? Your pips. And your account is $100. So you have a $100 account. And then you use a 0.1 lot size. So a 0.1 lot size. So lots on a $100 account, and your risk, where your stop loss is 50 pips away. It means if this trade go against you and hit your stop loss, you're going to lose, do the math, $50. because per pips is $1. So you've just risked $50 out of 100 on just one trade. Now, even if this is how your trade, based on your strategy, you win, you have a percentage as good as this, you are very likely to blow your steam, because if the first trade goes against you, you already have a drawdown of 50%. So let me just clean up all of this. If the first rate goes against you, you're now in a position, in a place where you now have a drawdown. So you have a drawdown of 50%. Now this pressure is, the pressure psychologically is massive. So it puts you in a very, very terrible condition, right? And in this state, you're more likely to make even more mistakes, because this is the time where panic sets in, and instead of following your system or your defined strategy, you try to react. You try to gain back at the market, and what happens next thing is you've blown the account. Now, even using the 50%, you might say, okay, so you might say that, okay, I don't maybe use scalp, or you don't use a definite stop loss. That is even worse, in my opinion. You need to think long term, right? You need to approach your trading like a business, and this is very, very important. So if you have a business, you're not going to try to make all the profits in one day. You buy something for, let's say, 100 naira, and you want to sell it for 2,000 naira, right? You can sell it for 2,000 naira to the first two people, who don't know that thing very well. But after you've sold to them, they'll probably never will buy from you again, and probably nobody else will buy from you. So you made profits once, and then you run out of business, after that, because nobody else is patronizing you. So it's kind of the same thing with the Forex market. You don't want to now, many times people only focus on potential gains and they forget what they are risking. You need to think in terms of capital preservation. So your first and foremost priority should be preserve thy capital, right? So preserve thy capital. After preserving thy capital, then you can now look to kind of like add to your capital and grow your account. But first thing, you need to preserve your capital, and that's why it matters a lot to size your position properly. Now, my advice would be, if you have an account size that is anything less than, I'd say, $300, you should not even trade anything bigger than a 0.01. Right? Now, a 0.01 is equivalent to 10 cents per pip, right? So, zero point 0.1 cents. Now, you'll be like, 10 cents per pip, how long before I even make money out of this thing? The focus should not be on money. In terms of, yeah, I know how that sounds, that's probably sound right in your ear. But really, your focus should not be on money, it should be on progress, right? By understanding and becoming consistent in making money using is micro lots, if you have a small account, right? Now, you've consistently, you've known how to manage your trade, you've known how to manage your account, you've mastered the process. There's no really mastering, it's an ongoing learning. And then you keep learning. Now, if you have a $300 account, and then you're risking 10 cents, right, per pip using a micro lot. And let's say each of your trades you take, they're about, let's say 50, let me just use an average of 50 pips. So let's say you're risking 50 pips to make, let me say you're risking 50 pips to make 100. So each trade you take, risking 50 pips, you're risking $5, right? So you're risking $5 per trade. Now, how many trades can you take? If you have 10 losses, straight back to back to back to back, 10 losses, that is just a total of 10 times 5, which is $50. So even if you lose 10 trades in a row, your $300 will only come down to $250. Now, we're not happy about losing, but this is a bearable amount, right? Losing, you've lost 10 trades back to back. That just sums up at, $250. As opposed to, let's imagine you decide to use, let me say, 4 micro lots. You decide to use 4 micro lots. where each trade is worth 40 cents. Or if worst of all, you decide to use a mini lot where each trade is worth $1. Now, if you're risking 50 pips per trade on the average, and you lose 10 trades back to back, each trade will cost you about 50 pips, will cost you $50. So you cannot even lose 10 trades. By the time you lose 10 trades, you'd have blown your account. Just losing 6 trades back to back, you'd have already blown your account. And then you either decide, man, this thing is not for me, or you start wondering who is pursuing you from your village. But this is just you, being not being shrewd with your capital. So your first goal is to preserve that capital and then look to grow your forex account after that. Now, another important thing I want to discuss is when it comes to margin, and it also kind of links very well with what I'm just discussing now. Margin. You need to understand, you need to also understand that when you're trading, I'm sure if you turn on your MT4, you'd see margin. Let's say you see your balance, you'd see equity, and then you'd see margin. Now, leverage is the ability which your broker gives you to be able to do more with little. So, for example, if you have $100 in your account, your broker allows, maybe giving you, let's say GC Market gives you 500 to 1 leverage, meaning you can control 500 times your capital. So if you have $300 in your account will function as if it is the equivalent of 300 times 500, right? So it's almost as if you could control this amount of equity, right, which is about 1,500, right? Now, for every trade, so there are 3 major types of lots, like I'm sure you know. So there's the mini lot, the micro lot, and the standard lot. So you have the, let me pick some of this up. So you have the mini lots, right? So you have the micro lots, you have the mini lots, and then you have the standard lots. Now, in the mini lots or in the micro lots, you can, each trade, you control about 1,000 units of each of the currency pair. On the mini lot, you control 10,000 units. On the standard lot, you control 100,000 units. Now, that is the reason why your mini lot is worth 10 cents per pip, your micro lot is worth $1 per pip, and your standard lot is worth $10 per pip. Now, the reason I'm pointing this out is it has a direct bearing to your margin. When you take a trade in the market, right? When you place a trade in the Forex market, the moment you place the trade, the broker, holds down some part of your capital as insurance. So, for example, you place a trade on Euro USD. So if you place a Euro USD trade and you use, let's say you use a standard lot, right? If you use a standard lot, placing the Euro USD trade, now about 2,000. So it's on a standard lot, you have about 2,000 of your capital, $2,000 worth of your capital is held down. Now, if you're using a 500 to 1 leverage, right? So you have your $300 functioning as if it's $1,500. So $2,000 out of your margin, your total margin, is held down. Now, this is huge because the more trade you have connected to your chart, the more trade you have connected to your chart, the more trade you have connected to your chart, the more likely it is that you keep piling up, stocking the margin. So you keep adding up to your margin, and then what happens is I'm sure some of you might have come across situations where you have trades open on your chart. Maybe many of them, some of them are in loss, maybe few of them are in profits, and then all of a sudden your trade closes, like all your trade closes, and then you end up with a loss most times. And then you'll be wondering, what happened? My broker just closed all my trades. Well, your broker doesn't close your trade, right? If you have a margin call, it means you don't have enough margin to accommodate all the trades that you've turned on. So automatically the system closes you out and close all your trades. And so even though some of them are in profits, you end up with a situation where have a loss. You take the trades close against you, and you have your position is in size. So it's in trouble. So trade sizing is key. You need to pay attention to that. On to the next topic, win rate versus win ratio. Now I love this quadrant system because it's kind of this is basically um, this is basically um, these four major areas you have in terms of traders, right? The four major areas you have in traders. So this is more or less like a graph. The way I look at it is more or less like so you have win rates. So let me call this. I'm going to put this is going to be like 0, and this is so you have. Let me call this win rates, right? And then let me call this win ratio. So I'll just write WR, right? Now, so you have win rate versus win ratio. Now, at the top here, you have, let's say 100, or you have high. So low, high. So this is going to be like high. This is also high. So forgive my drawing or my writing. Now, here is the thing. There are four quadrants. Here is you have low win rates, right? And also low win ratio. Here you have high win rates and low win ratio. Here you have high win rates, high win ratio, and here you have low win rates but high win ratio. Now you're wondering what exactly is what's been talking about here, right? Now win rates is just in terms of how many on the average. So if you take 10 trades, so let me use a sample size of 10 trades. So if you take 10 trades, how many do you win? If you have an average of 10, like if you win 10 trades, you have 100% win ratio. Now we know we don't really have 100% win ratio, on the long run. But you can have a trading system that you win, let's say about 50% of your trades. Now that's not a bad win ratio, right? Now, 50% of your trades, if you have a 50% win rate, and then win ratio, let me define win ratio. So win ratio is what is the ratio of your wins to your losses, right? So for example, if you risk $10 to make $20, your risk to reward is 2 to 1, right? So if you risk $10 to make $20, you have a 2 to 1 risk to reward. However, if you risk $2, right, or let's say you risk $20 to make $10, you see how that is a lower risk to reward ratio. Now, there's no rights, there's no holy grail, the exact system to do this, right? You have to follow the system. But what I know is you cannot make money in this quadrant. You want to be in any other quadrant but this quadrant. So this quadrant of low win rates, low win ratio is a no. Now, you can make money on this quadrant. You can make money on this quadrant, but this is where we all strive to be on this quadrant. Now, you can make money on any of this quadrant, and that is the priority. So in this quadrant, you have a high win ratio, and then you have a low win rate. So it means you have, let's say you win about 80% of your trade, right? You win about 80% of your trade. So on a high, okay, this is a high win ratio and low win rate. So you win about 80% of your trades, but then you don't, let's say you risk 1:1, so you have a 1:1. So imagine if you're risking $1 to make $1, but you win about 8 out of every 10 trades. So if you do the math, if you risk $1, so if we risk $1, right, to make $1, and we win 8 out of every 10 trades. So our wins, if you do the math, would be $8. So we win 8, and we are looking to make, for each trade we make $8. And then for each trade we lose $1 per trade, which is also $1. So you see, at the end of the day, when you so we lose 2 actually, because we lost 2 trades, so we'll have $2. At the end of the day, we'll come out with a net gain of 8 minus 2, and so we have a total of $6 net profit. So this is a system where you can have high win rates and low win ratio and still come out profitable. Now the other example, the other system would be where we have a so on this other quadrant, so we have a low win rate but a high win ratio. So we have a low win rate and then we have a high win ratio. So this means that we, in this case, right, we are risking, okay, so let me take this off. Yeah. So in the second option where we have a low win rate, like, right? So let's say out of every 10 trades, we win only about 4 trades. So we win 4 out of every 10. So 4 out of 10 is our win ratio. But we have a higher win ratio, right? So we win, our win rate is 4 out of 10. But for each trade, we are risking, let's say, $1 to make 4. Or let's say we are risking $1 to make 2. So we risk $1 and we try to make $2, right? So this is a 50%, a 1:2 risk to reward ratio. Now remember, we have a low win rate, but we have a higher win ratio. Now, if we take 10 trades, still using the 10 trade sample size. So if we take 10 trades, right, and out of those 10 trades, based on our win rate to win ratio, we win only 4 out of 10. That means we lose 6. So this is what happens. We win 4 and then we lose 6, right? Remember, we have a 1:2. That means for every $1 we risk, we are trying to make 2. If we lose 6, that is 6 times 1. That means we have $6 loss. But we only won 4. So we have 4. For each trade we risk 1, we make 2, or we are targeting 2. So we have 2. And then in total we have 8. So you see that the net gain is $2. So you come out with a profit, even though you lose more trades than you win. I know this is kind of like maths, but not necessarily. I'm sure you probably were thinking I should show you the chart and all, but this is, understanding this concept would help you to stay away from trades. There's some trades I see the trade setup looks fine and everything, but probably because of my own system, the way I approach the market, I look for higher win rates. Personally, I like to trade. I like to look for higher win ratio. I'm trying to risk 1 to make 3 to make 4, so that even though I take only 2-3 trades per week or in 2 weeks, and let's say I lose 2 out of them or 1 out of them, I come out at the other end much more profitable because I have a higher risk to reward ratio, right? Now, the other quadrant, which is where we all strive to be, is where we have a high win rate and a high win ratio. So we have high win rates, we have a high win ratio. So say out of every 10 trades, we win about 6 trades, which is more than half, or maybe 6 or 7. And then we risk 1 to make 2 in each of our trades. So you see the whole concept now comes, it now comes alive. Imagine if we have a system, our trading strategy is such that we risk, for every trade we take, we are risking 1 to make 2, right? So we're risking 1 to make 2 every single time. Now, if we're risking 1 to make 2 every single time, and then we win 6 out of every 10 trades, that means, if we do the math, you find out that, now you're now talking of some serious finance, right? You're talking of some serious gains. So let me pick up my pen. So we're risking, we have a win rate. So a win rate of 60%, right? And then we are risking 1 each time to make 2. That means out of 10 trades, 10 is just a sample size, we win 6. So we win 6, we lose 4. Now this 6 win will be $2 for each trade we win, right? Times 6, which is about 12. But for each trade, we are risking just $1 and we lose only 4 times. So now you have 4 and then you have a total net of $8. Right now, I'm just keeping this at the bare minimum, right? Now, because I'm trying to assume a lot of us, are starting out. So I usually try to encourage my newbie traders to, start with a low lot size so that you have room to fail, because you don't want to have a situation where 2 failures cost you your entire trading capital, or 3 failures or 4 failures. You want to have room so that when you fail, you have opportunity to recover. Now, once you've look at this, that's why I said focus on process, not on profit. Now, as you keep doing and getting better, you get to the point where you now have more confidence in your trading. You have a trading system or systems that work. Now, when you grow, usually people usually think, oh, I have fund my account $500, and then I'll turn my $500 to maybe to a million dollars, or maybe $100,000, so that I can be making about $10,000 a month. While that is not necessarily impossible, right? It is unlikely. If you find profitable traders, they are people who have bigger funds in their account, right? So you get to the point where you've understood the system, you have a system that works, you're getting better at trading. And what you need to do at that point is add to your capital, right? You want to fund your account more so that you can remember we are looking to minimize our risk per trade. So if for example, I said, just like I pointed out, you want to risk not more than 3% of your account per trade, and your account size is, let's say, $300, and you've been trading, and you see, you've gotten more comfortable with the system, with the market and the system of your trading, and then you want to increase your profit potential. That means you want to be able to start making, instead of using a 0.01 lot size, maybe you want to start using a 0.1 lot size. You're not going to just increase your lot size based on with your capital being the same, because then, when you lose a couple of trades, it will give you back a bigger drawdown. So what happens in those cases? You want to probably fund your account so that you have an account, a capital, where when you take the 0.1 or the mini lots, you are still risking less than 3% of your capital. And then now you have it's still the same trades you take, the same system. 10 pips is 10 pips, right? 100 pips is 100 pips. The only difference is 100 pips on a standard lot is $1,000. 100 pips on a mini lot is $100. And 100 pips on a micro lot is just $10, but it's the same 100 pips. So once you've gotten more confident and you've gotten better at trading, and you've increased your capital to be able to make more on the market, you're not going to do something different. That's the beauty. This is the reason why I love Forex. Imagine if you need to increase your earnings in terms of your income. You go to your boss, or you look for you need to do extra jobs, do other side hustle to even double your income. But in the Forex markets, if you've gotten so good at a system, what you need to do is still the same things you do. You still go for the same trading strategy, just because you're using a better lot size, and then you make more money. And then it's not just about increasing your lot size, it's about having a lot size where you're not risking so much of your capital per trades. I hope we all get the concept very well. I hope what all I was trying to explain here, makes sense to you. And now, just like I promised, I want to give up some bonus session, right? So I want to give up some bonus trades. So I'm not sure we have many questions, but if you have questions, you could easily type them in the chat box, whether they are related to this particular topic or something else. You want to do well to put it down in the chat box. So the bonus trades I wanted to give out is based on this. I think the last few classes or class I did, I think I pointed out silver, which is XAG and I've actually been buying silver for a long time. So I've been buying this pair, I took some partial profits at this stop here, and right now I'm even more bullish than I was in the past. Now, if you look at this pattern, you see a bull flag. So what I mean by a bull flag, you see this the price is rising, and then you see this channel here where you have price going in a flag-like pattern. So let me draw on my screen. So you have price rise up like this, right? And then we now have the market doing this. So we have this market is trading between this channel, and then market found support at this level. Now you see market has broken out above this channel. Now, just like with everything in the forex market, just like the way the forex market, sorry, functions, which is why I love the market, is that the market, we can kind of more or less predict the way price move. We don't know when it will do that, but we can predict how price move, and we try to take advantage of it. Now, usually when market breaks support or a channel, when it breaks support or resistance, it usually tends to retest those areas. And I pointed out to you guys that we could see a backside retest of the channel support, of the channel resistance, this previous resistance as new support. And sure enough, we got that retest here. So if you look, we had a minor retest here, then we broke below this trend line. So I bought around here, right? And I was expecting price to go up, which it did. And then when we broke below this trend line, so let me highlight this. There's a trend line that runs like this. So you see, there's a trend line that runs like this. You see how price. So when we got this break below this trend line, I was expecting that we'll get some pullback, probably towards this previous area here. So I pointed out in the last class, I think, that I was looking to buy around here, and I did. I was looking. I pointed out that I bought the pair around here, and this is what I was risking, right? And now you can see this is overall where I'm targeting. Actually, based on this price structure, I do expect silver to go as high as to come back and retest. So if I go to the all-time frame, I do expect silver to probably come back up to 4,200, right? This 2021, so this what we could see price rally up way higher than it currently is. But first, now my first target is this area here, which is around where this previous multi-year trend line is. So current level, so when we're currently where price is to this current level, when it comes to gold and silver, they tend to move a lot. So this is about we're looking at from about 271 pips. I'm already up about 820 pips already on this pair, and it says about 271 pips on the gas. Now, you mean before you choose to jump in or not, you want to be sure that you have a capital size for it, because unlike other currency pairs, silver and gold, and oil, they have higher volatility. So if I don't advise trading these commodities with anything less. If you have anything less than, I'd say $500 in your account, or at least $300 in your account. And even if you do that, you want to manage your trade easy properly, because just a short move, a daily trading range of these currency pairs or these commodities are really huge. But the potential for this is high. I do expect a break. Or, if you get a break, what you could do then is this. What you could look to do is this. So if we, or when we get price break above here, right, watch for a retest of this area. So the price will do something like this before start making the next move higher, right? So you want to pay attention to that. So at current price, it might already be too high to buy, because you need to put your stop loss probably below here. What you can look to do is wait for a break, and then confirmation. Once price come back to the Tesla area, you could look to buy up to this area. So please mute your mics. Another pair doing something interesting also. One of them, the AUD USD. It has this harmonic pattern which is setting up quite nicely as we speak. Okay. So I've been waiting because the market, the USD has been really weak and it has been very, very overextended. I do expect this market to overall get up to this area, which is what you, as I just removed now, you saw it was the target. But for the short term, I expect, I see the price coming down because you could see that the price is ranging very tightly. You can see here that it seems we've had a trend line break, right? So we have a trend line break here, and so it has already just currently retested this area. So this backside of this area. So this trend line break, because market is currently overextended. If you pull up, let's say the RSI on this pair, you'd see that price is really overextended, is overbought, and then volume divergence on this pair. It's the divergence is you have a hidden divergence where price is making higher highs, but then volume is making momentum is making lower highs. And so we tend to see price rally in the other side, right? So what we are looking at, so, there's this, you could have this, so I have this, so XA, we have the XAB, CD pattern, right? And so based on this price structure, I do expect price to pull back to this. There's a level here where there's imbalance in the market. So I expect price to pull back overall, at least somewhere between this area, right? This area and this area here, and this is a huge move. So in the coming weeks, in the coming months, we could see dollar strengthening, and so this is what you should be watching out for. You could, look to sell from this stop. Your stop loss should be above this area. This is the first target. This is the next. If we get a break, so the way you play it is, you don't necessarily need to play the swing long trade. Even if you're scalping, the idea is you want to scalp in the direction of momentum. So if price is falling, you want to be scalping and you're looking for buying opportunity. If price is rising, sorry, and you're scalping, you're better off looking for buying opportunities. And if price is falling and you're scalping, you're better off looking for selling opportunities. So if you're looking to swing trade this market, you could look to buy to sell the support or the resistance, trade that down to here. And then if we get a break below here and a retest, you could look to sell that back down to here. Because eventually the price would still, I think the overall direction of the AUD USD is actually higher. So, but the current swing, the current momentum has shifted from making higher highs to making lower lows, to making lower highs. And then because of this trend line break, we would likely see price, dip, even if it's temporarily. So we could have a dip, like this, where we have price come back down, either one of this level, and before making the next move higher, right? So we could have something like this play out where we have price come back down and it's necessary, come back down to one of this level before going to the overall bullish target. So this is one of the ways you could play out that, and these two trades, you could look to play them out to your own system. I hope we grabbed a thing or two from the entire training today.